Many people will say that they've heard this strategy before, but when it comes down to executing it in the live markets, they fail and lose money. Why is that? That's because they're missing the 7 key ingredients to making this strategy successful and profitable. Others call this idea the liquidity sweep. However, make no mistake about it, many people fail to execute this properly and they end up losing money because they're not doing the 7 things I'm sharing with you in this video. Especially the last 2 keys, which could mean either blowing up your accounts or getting your accounts to pay out. So make sure you watch till the end and know these 7 keys that you must do. A liquidity sweep is simply entering a trade by taking advantage of people's stop losses. The market repeatedly sweeps the low where normally stop losses are placed. For example, this morning, the market open was right here at 21185. They swept it just 10 points below at 21175 area, and then it bounced and shot up a good 30 to 40 points. So that's more than enough for us to bank. If you want to win and make money in this market, you have to do the opposite of what most people are doing. Most people are setting their stop losses at the low of day or near the low of day, and that's why the market likes to sweep those area and then immediately reverses after taking out those stop losses. The same thing happened later today when it swept that previous low here and it bounced a good 20 points, which is all we need as future scalpers to make our money. When people hear of liquidity sweeps, they think, oh, it's easy, just go buy when they swept it. And that is why many people fail with the scalping strategy, but not you, because you're gonna know the 7 criteria to entering this liquidity scalping trade so that you can bank. When other people are getting stopped, you're getting in and you're locking in profits. Number 1, this is one of the most important factors for liquidity sweeps on the 1-minute chart. Entering at speed candles. What exactly is a speed candle? A speed candle is when you see price moving towards a level that they're going to sweep, and they do it in a heartbeat. And it's down 10-20 points. In that instance, you immediately buy because it was a speed candle. Many people make the mistake to buy the grind down candles. They look at a chart like this. Oh, this is where the previous low of day is. And so they buy the moment it cracks below this previous low of day, and they get stopped out as it goes lower because this was a grind. It wasn't a speed candle. The larger and faster the sweep at a key level, the better it is to buy. When everyone is panicking and selling, that's when you scoop it and lock in that 10, 20, 30 points on NQ and bank. Number 2, many people like to nickel and dime on 1 to 2 ticks. And that's why you hear people say, man, just missed my entry by a tick. And if that repeatedly happens to you, it means that you've been too cheap on the entries. Instead of trying to buy on a limit order, when you see it sweeping on a fast candle, you go and hit it on market order. Remember, we're trading futures. The slippage on futures is much less than on Forex. When I traded Forex prop firms before, the slippage was unreal. But the good thing with futures is that the slippage is very little. So you can mark it in, get in, and get out without missing the trade because you were 1 to 2 ticks short of your limit order. Number 3, the 30 to 60 second rule exits. I can tell you that some of my best trades were in and out within 15 to 20 seconds. I buy the fast candle, boom, enter in, and instantly in the next candle, within 60 seconds, it bounced 20 points, which is normally what I'm aiming for anyway. What I like to do is buy 4 contracts as normal size because I trade big accounts like 150K accounts at Tradeify Instant Funding. So I do 4 cons, I sell it on the way up. If I'm dipping it, I exit around 10, 15, 20, 25, and 30 points. I like to trail the last contract for maximum gain, but my first 1 to 2 contracts, I'll exit around 10 to 20 points. And as you can see right here, this morning, I played this bounce for sure. I bought the sweep and I sold it on the way up. Number 4, lock in the 10 to 30 points on NQ. As the saying goes, bulls make money, bears make money, pigs get slaughtered. Don't be a pig. I know you see YouTubers, big ones, saying that they ICT this, SMC that, 80 to 100 points on 3 to 5 micros. Good for them. But frankly, locking in 80 to 100 points every day is not an easy task. Sometimes the market chops around and you don't get that. The more likely approach for you to lock in your profits is the 10, 20, and 30 points. Because as you can see, on a chop day like this, there was no 100 points to be had, even if you bottom ticked or top ticked the market. However, if you locked in 10, 20 or 30 points, you would have locked in your profits repeatedly and took even more trades. That banked. So make sure you don't be greedy. No need to be a hero. Just lock it in and bank. Number 5, allow 3 entries with 3 different accounts. That's right. Not 3 entries copy trading 10 accounts or 20 accounts, but 3 entries with 3 different accounts. Why? Because we rotate the accounts to spread out the risk. So if I'm wrong on one trade, and you will be wrong on a trade because no one has a 100% win rate, your risk will be spread over multiple accounts so you're not killed on one bad trade copy trading 20 accounts. Let's say you bought the sweep right here on the first account. It stopped you out on 10 points, which is my normal stop loss. But then you rotated to a second account right here, almost bottom ticked it, and now your second account gets a 2R or 3R win, whereas your first account only took a 1R loss. Risk 1, make 2 to 3. That's how we continually bank, by allowing multiple entries on multiple accounts. But why 3 entries and 3 different accounts? Because remember I told you the last 2 key ingredients are very important for you not to blow up your account but actually getting the payout. Here they are. The reason why we need 3 entries on 3 different accounts is because number 6, you need to stop this strategy in sweeping the quote-unquote lows of the previous candles. When you see that after 3 entries on 3 different accounts, the price action is not reversing, it's not rebounding, or if you're shorting it, it keeps on going up and it doesn't drop. As you see here on this chart, if you keep on dipping this 10 point stop loss, 10 point stop loss, 10 point stop loss, and you keep doing it down here for 100 point down, you would have stopped 10 times, and by then you probably tilted and blown some of your accounts. This scalping strategy of sweeping the lows of previous candles using the liquidity sweep strategy only works when it does not have a grind down or straight up action or displacement candles that go 50 or 100 points straight down. As you can see, if you bought the sweep of the previous 1 minute demand, it went lower, and then this went even lower. When you've been stopped out 3 times, make sure you stepped away, wait for some consolidation before you engage the sweep again, or else you will blow your accounts. But when it is ready and the price action seems to stabilize, you need to do number 7. You must execute, and do not doubt when the time comes to execute the trade. When was the last time you looked at the chart and you say to yourself, man, this is a good level, I need to get in now? But no, let's just wait for another 2 to 3 points lower and I'll get in. And sure enough, as you waited, the price snapped exactly the direction that you anticipated, and yet you're not in the trade. When it is time to execute the trade, and when you have seen the sweep, you immediately mark it in and get long. You don't cheap out. You go for the rubber band trade, 10, 20, 30 points, and lock it in. Because you need to understand this. Trading is a risk-taking business. If you're always afraid of loss, then don't trade. If you want to be 100% safe all the time, take 0 trades and you'll never lose ever. However, you'll also never win. The worst thing about missing a trade and not executing is FOMO. When was the last time you missed an entry? You told yourself, man, I can't buy it up here now, and then it rips even higher. I missed the entry down here, I can't buy up here, and so you don't buy this dip, and it rips even further. And you say to yourself, wow, this is so extended now, there's no way I would buy. And then it rips even further. And so you're like, you know what? They're just gonna keep squeezing. They're not gonna come down. I'm gonna buy the next dip. And so right here, you're like, all right, I'm gonna go for this dip. You bought it right here. You don't lock it in 10, 20 points like how you should. You're trying to hold for the moon, and guess what? You get dumped here, stopped out. Now you mark it in with the next account, it drops even more. You double in, and boom! It washes you out. You blow the account right here, and then it snaps right back up. Now you are livid. There's no way I allow this to happen to me. And so as you see this candle pushes up, you mark it in full port, copy trade 5 accounts. I'm gonna get this all the way back up here, and guess what the market does? It rejects. Boom! And all your copy trade accounts blown. Do I need to continue the story? I think you understand how tilt looks like and what revenge trading looks like because we've all been there. How do you think I can describe that in such a detailed and vivid manner to you? Because I've been there. But the good news is, if you watch the entire video till now, you have the 7 keys in your hand to properly execute the liquidity sweep strategy. Sweep short is exactly the same, but only on the inverse of the long. Like right here, it sweeps to the upside, you immediately hit a short, and you lock in a 10 to 20 or 30 points to the downside. Drop a comment if you got a question, join our Discord for free, smash a like button, and I'll see you on the next one.